And we're back with accounting. Yeah, it's been a crazy week with a massive to-do list, but it has now been dealt with, and I can now return to producing these epic YouTube videos. Probably the most boring videos on the internet. Let's continue to the valuation of accounts receivable. So this is the final part of looking at accounts receivable valuation, and we're looking at estimating uncollectible accounts. So we've previously discussed that the allowance for doubtful accounts and bad debt expenses are estimates. Now, the way that these estimates are made differs depending on the method that you want to use, and there are two of them. First is a percentage of sales. So the idea here is pretty basic. It's just based on however many sales you make, you estimate that a certain percentage of those sales won't be collectible. And there's no real ironclad way to know what this percentage would be. I mean, it would depend on what kind of business you're in and what kind of clients you have. So this is something that's usually decided by management, and it's usually decided based on experience. And the other one is, it has a similar rule book, but it applies to something different. And the method that this is carried out with is also different. So instead of percentage of sales made, this is a percentage of your receivables. So instead of just looking at all sales made, whether it's cash or accounts receivable or notes or whatever, it's just accounts receivable. And it's still a percentage basis. And it's still based on management experience. The big difference between using a percentage of receivables is how you actually make your estimate and how you record that estimate. Okay, so we're going to start off with the easy one, which is the percentage of sales basis. When this is, if you're wondering how to know which one to use, by the way, the questions should tell you. There'll be, some of them are fairly subtle. I mean, hopefully you guys have done your homework from last week by now, and you've noticed that in the text of the question, it'll say something like, it's management policy to accept 2% of sales as uncollectible debts, sort of thing. Or I don't remember the exact language, but something like that. So all you have to do is determine what percentage of credit sales, or sales if credit sales is not available, will be uncollectible. So all you got to do is look at the number or the value of credit sales for the period, and if management were to conclude that, say, 1% is going to be uncollectible based on past experience, they'll usually say that, by the way. They'll usually say based on past experience in the question. So if they decide that 1% is uncollectible, then you just take 1% of 500,000, and that's 5,000. So then the way you record it is you add it to your bad debts expense because you're assuming or estimating that this will not be collected. So we entered that in preemptively. And then we just add that balance, or not balance, but you add that amount to your allowance for doubtful accounts element, which is normally a credit balance, even though it's in the asset column, because it is a contra account. So again, this is an allowance for how much bad debt we can accept, sort of thing, and this gets used up, just to review from previous lessons. And so by doing this, you're matching your expenses with your revenue, which is nice as far as the matching principle goes. When you're actually doing this and when you're recording this in the AFDA, you don't take into consideration how much allowance you have left, say from previous periods or previous statements. You just keep adding. So that in a way, that's what makes this the simple method, is that you're just adding on the percentage that you believe will be uncollectible to whatever balance is in the AFDA. Okay, so this is the more complicated one, but it's also the more accurate one, and therefore it's the one that's more often used. and this is the percentage of receivables. So we start off in the same way. The trick here is sometimes when you're given a set of events that you have to journalize, things will happen to accounts receivable. Like you'll have maybe a previous balance, and then you'll have a bunch of different sales made on accounts receivable, and some other accounts receivable will be cleared. So there's a varying value in what the amount for AR will be. And you need to figure that out first before you do any percentages. Okay, so assigned to accounts receivable in total or stratified by age of receivable. So stratification classifies customer balances by length of time they have been unpaid and applies a certain percentage to those classifications. So in a nutshell, the longer the debt is unpaid, the higher percentage we get in terms of how much of that debt is uncollectible. So, between 0 and 30 days, it's still highly likely that they'll pay you back. When we get to 2 months, a little less likely. 3 months, a little less likely. Half a year, it's like, okay, he's probably not going to pay us back now. So the longer we go, the higher the percentage of estimated uncollectible debt will be. And that's why we say the percentage increases, because the longer the debt isn't paid, the more likely it is that they're not going to pay us back. So an important point here, the method focuses on the balance sheet and determining an accurate net realizable for AR. Now, this is where things get tricky, and this is one of the main differences between using percentage of AR versus percentage of sales. When you use a percentage of accounts receivable, you have to consider the amount that's already in the AFDA element. And this is where things get a little dicey. So when questions or when companies tell you that they want a certain allowance in the AFDA account, you don't just add that in. You need to figure out exactly what allowance is left and then add the difference. And figuring out what's left can be tricky. There are now the homework questions that I have assigned, particularly the problems, give you lots of practice in doing this. So definitely look at those and look at the solutions. So what does disposing of accounts receivable actually mean? It's not what you think it means. I thought it meant just dealing with it and getting it resolved. And in a way, yes, but it's a specific type of resolution. What it means is that companies are actually selling their accounts receivable to other companies for cash. And there are two reasons to do this. The first is that the company that's selling the accounts receivable can get cash faster, because instead of waiting for someone to pay for it or to pay their debts back, they can just get it's a lesser amount of money, but it's still immediate money in cash from another company. The second reason is the company who has these accounts receivables doesn't want the hassle of billing and collecting the consumers. When someone defaults on their debts, legally speaking anyways, you can't just call the police, or you can't just send a couple goons over to their building to beat the money out of them. That doesn't work. You have to follow a step-by-step sort of chain of procedures. And the first is writing emails and reminders and phone calls, and then sending legal documents and filing for legal claims, and then lawsuits, and you have to hire lawyers, and it's just, companies will do it, but it's a very long, very annoying set of procedures. And some companies just don't feel like dealing with it. So they will sell their accounts receivable to other companies who will deal with it. And if you're wondering why they do that, the reason is that they will sell, for example, let's say you have someone who owes you $10,000 and you really need money, and you've tried contacting this person and they're not getting back to you. You might go over to another company and they might say, okay, look, we'll buy this $10,000 debt from you for $5,000. So the benefit for you is that you get $5,000 in your pocket right away, which is nice because you need the money, right? And the benefit for the company that just gave you $5,000 for nothing, really, or at least that's what it looks like, they're betting on the fact that they can get this person to pay them the $10,000. So if they're able to get this customer, this former customer of yours, to pay them, then they'll make $5,000. So it's a pretty sweet deal for both parties, assuming that the people who buy the debt from you can actually get paid. So in terms of actually disposing of accounts receivable, one is called factoring receivables. And what this means is that a factor buys receivables from a business for a fee. Factor is the name what we call companies that buy receivables from a business for a fee. I guess it is a name, but it's not an actual company name. It's just the name of that type of business. Factors then collect payment directly from the consumers. So they're the ones who will write the mails and make phone calls and file claims and go to court and get a lawyer, etc., etc. Another way is credit cards. And this one's kind of interesting in that it's a form of selling accounts receivable by the business. Now, credit card companies are responsible for collecting from the consumer, not the business. So the way that credit cards work is when you buy something with a credit card, the credit card company pays for the product and then you pay the credit card company. And so it forms this sort of triangular relationship. And the credit card company, so Visa, MasterCard, is the one responsible for getting the debts from the consumer. And they're the ones who, they send you invoices every month and they charge you. It's a crazy amount of percentage. Don't ever get into credit card debt, by the way. I'm sure you guys are smart, so I'm sure you know this, but just in case, do not spend more on credit cards than you can afford to pay, because the percentage that they charge will bury you. They charge, I think it's something like 26%. It's insane. They rack up a ton of money if you don't pay them back. Some family friends got into a lot of credit card debt, and it did a lot of damage to their finances. So don't do it. Only buy something on credit if you know that you can pay for it. Okay, so business gets paid right away from the credit card company, no matter what. Now, I guess the catch to this is in exchange for not having to worry about cash collection. So they get paid by the credit card company right away. But there is a fee that the business has to pay to the credit card company. This is why, if you've ever wondered why small businesses, especially restaurants, don't take credit card, this is why. Because they don't feel like paying that small fee to the credit card company every time they sell a product. So types of credit cards. There are bank credit cards and non-bank credit cards. Now, bank credit cards, I believe, are the most common. And if you have a credit card, you probably have one. For example, we have Visa and MasterCard, but they are tied to specific banks. For example, mine is an RBC Visa. A bunch of my friends have Toronto Dominion Visas. Haven't seen many MasterCards, actually. But so what happens is when a sale occurs, the bank immediately adds the amount to the business's bank balance less the service fee. In other words, they pay, or I'll back up. When you use a credit card to buy something, the credit card company is the person or the entity that pays for it right away. And then they charge you. Now, what this does is it forms sort of a triangular relationship in terms of the fact that there are three parties to this transaction. There's the customer, the credit card company that's paying for the product from the business. And the credit card company does this in exchange for a small fee from the business. And it's percentage based, but I think there's also a minimum value. Like I I'm not sure about this, but I think at some point it's no longer a percentage. It's just a certain dollar and cents amount. But anyway, an example is customer uses her Visa to purchase a $700 TV from a business. And the Bank of Montreal charges the business a 3.5% fee for each credit card sale. Okay, so this is how to record a credit card transaction. Now note that this is from the point of view of the business, not the customer and not the bank company, or the credit card company. So because the bank pays the cost of the transaction right away via wire transfer, we recognize it as cash. So we debit the cash account for whatever the amount of the sale was minus the credit card expense, which was 3.5%. And 3.5% of $700 is $24.50. And then to balance out the entry, we credit sales for the total amount, which is $700. I found this error. I'm not sure what happened, but if you saw this slide earlier, it looked like both credit card expense and sales were credit entries. But hopefully you realize that that wouldn't make sense, because then the left side would not be balanced to the right side, because it would have been $675.50, and then the corresponding credit entry would have been $724.50. And hopefully you guys know that whenever you make an entry, the total amounts for the entry must be balanced. So 700, 700. Okay, so non-bank credit cards. So American Express or Discover. So these are companies that perform the same function as bank credit cards, except they're not attached to any bank. They're their own separate entity. Oh God, Hudson's Bay, that takes me back. Okay, so when a sale occurs, the business records it as a credit sale until the credit card issuer sends the net amount to the business. For example, assume the same information as the previous example, so a sale of $700, except the customer uses Amex to pay instead of Visa. So at the time of sale, and again, we're recording this from the point of view of the company selling the television. So we debit our accounts receivable instead of cash because we're not getting it instantly. These companies are not banks, and therefore they can't make bank wire transactions instantly. So we debit accounts receivable, and we label it as Amex so we know who the money's coming from. And then the corresponding entry to balance out the this whole transaction is the credit card expense as per usual, and we credit sales for the total amount as per usual. So that's the only difference. Now, when Amex actually sends the cash to the business, we debit cash and we credit accounts receivable because we're no longer receiving this amount. We have, in fact, received it. So we have the entry in as debiting cash to recognize that. And that is it. So that's it for the last part of accounts receivable. I will now make a YouTube video about notes receivable. So stay tuned for that, and I hope you enjoyed your Friday. See you guys soon. Bye.